Wall Street wakes up to a contradiction it can't explain. Markets are rising, but the country beneath them is shrinking. Overnight, a cascade of layoff filings flashes through federal servers. Nearly 1 million jobs erased before breakfast. In Washington, President Donald Trump is already on camera, insisting the economy has never been stronger. Beside him, Treasury Secretary Scott Bessent defends the tariffs that were meant to rebuild American industry, but are now bleeding it dry. Corporate statements read like copy-paste apologies, restructuring, realignment, efficiency. In Texas, factory inventories are piling up. In New York, traders whisper that tariff revenues are disguising a fiscal hole too wide to hide. And halfway across the world, Beijing's tech sector, once throttled by U.S. sanctions, quietly posts record profits. Something has inverted. The harder Trump and Bessent fight to defend the dollar, the faster its foundation begins to slip. Factories confirm the signal. The Institute for Supply Management's manufacturing index has slipped below the 50-point line for 8 straight months, marking continued contraction in the sector that still accounts for roughly a tenth of U.S. output. Purchasing managers cite slower new orders and lengthening supplier delivery times amid tariff-related cost pressures. A parallel gauge from S&P Global shows headline improvement, but with export orders under strain and inventories building. Causally, trade frictions and weaker external demand compress order books. Compressed orders translate to thinner shifts. Thinner shifts show up first in hours and then in separations. Policy remains the variable with the highest amplitude. After a federal appeals court ruled that most tariffs imposed under emergency economic powers exceeded statutory authority, the administration appealed and simultaneously mapped alternate legal routes. Officials now emphasize that even an adverse high court ruling would not end the program because other authorities exist under national security metals statutes and legacy trade laws, including Section 232 and the rarely used Section 338 of the Tariff Act of 1930, which allows retaliatory duties up to 50% following findings of discrimination against U.S. commerce. The practical implication is continuity tariff schedules can be recut and reassigned to new statutory hooks, preserving the price effects while litigation churns. Receipts show up on the ledger. Net customs duties have climbed sharply, helping offset outlays elsewhere and contributing to a slight narrowing of the annual deficit to roughly $1.7 trillion, according to Treasury data summarized by Reuters. Earlier budget statements had already documented the driver customs revenues rising as new and higher rates took hold, even as total outlays accelerated on interest and health costs. The mechanical pass-through is simple. Tariffs raise border taxes collected by customs. The same measures lift input costs for import-reliant firms, a burden partly absorbed in margins and partly passed to final prices, as purchasing surveys and earnings calls have indicated. In short, the Treasury's top line benefits while cost pressure rotates to producers and households. The job market's internal composition clarifies the distribution. Federal payrolls have fallen by almost 100,000 this year, with declines in government employment offsetting pockets of healthcare growth. Manufacturing headcount is down around 78,000, with transportation equipment employment slipping as work stoppages ripple through suppliers. Longer unemployment spells, growing to a quarter of all joblessness, typically imply skill mismatch and slower reabsorption. Dynamics consistent with tariff-shocked supply chains and a high cost of capital environment that delays new investment. When financing is tight and inputs are pricier, marginal projects are deferred. Deferred projects reduce openings. Reduced openings lengthen spells. So, monetary policy is reacting, but, cautiously. The Federal Reserve recently cut its policy rate by a quarter point and stopped the balance sheet runoff. Still, Chair Jerome Powell made it clear that any follow-up move would be a tough call, especially with limited official data during the government funding lapse. According to the Fed's implementation note, the interest rate on reserve balances has been reduced to 3.9% and the primary credit rate to 4%. Markets sort of toggled. The dollar actually strengthened after Powell remarked that another cut was less likely, even as bond yields drifted lower on expectations that easing could resume into next year. The path of rates now really comes down to balancing labor market cooling with the optics of inflation-linked pass-through from trade levies. External balances are definitely showing the stress. The IMF reports that the U.S. current account deficit is close to 4.6% of GDP, which is almost 2 percentage points wider than the long-term average, with trade frictions and fiscal dynamics both playing a part. The fund's fiscal monitor flags the United States as maintaining the largest deficit among advanced economies through the decade under baseline policies, with gross debt ratios rising unless there's some consolidation. If tariffs stick around while rates fall, one near-term channel is currency weakness paired with pressure from imported goods inflation, a combination that can help exporters but really strains real incomes. The policy trade-off is explicit fiscal revenue from border taxes versus the cumulative cost in prices, volumes, and household budgets. Technology policy? Well, it sits at the cross-current. After a year of export controls on advanced AI accelerators, those measures collided with China's import restrictions and a push for substitution, basically turning a once profitable region into a blank space for the U.S. industry's dominant supplier. NVIDIA's chief executive told investors that the company's share of China's AI accelerator market had dropped from roughly 95% to effectively zero, and that China would be set to zero in planning assumptions until policy or demand signals shifted. Earlier, NVIDIA indicated it would exclude China from revenue forecasts because of tightened U.S. rules that halted sales of compliant variants. The commercial vacuum has encouraged domestic Chinese alternatives, while Washington has doubled down on enforcement, a cycle described by U.S. officials and industry leaders in recent briefings. The effect controls have reduced U.S. supplier exposure, but have widened incentives for import substitution by the world's second-largest buyer of compute. Downstream handset and server supply chains have actually adapted faster than expected. Reuters and Bloomberg both chronicle Huawei's return to 7-nanometer class chips powering flagship phones and AI servers via domestic capacity, even as analysts continue to parse yields and performance gaps. U.S. measures have narrowed legal paths for Western equipment into these nodes, but every closure has just raised the payoff from incremental local progress, an effect NVIDIA's chief executive summed up earlier this year, arguing that cutting China off had spurred development there instead of freezing it. The policy technology loop, honestly, it really matters for the U. Domestic manufacturing has not yet delivered the rebound suggested by the scale of protection. ISM's months-long contraction captures broad softness in new orders and production, while S&P Global's composite shows services still carrying growth but with sentiment darkening on trade uncertainty. In the government's establishment survey, manufacturing employment remains lower on the year, and wholesale trade is sliding as well, framing a supply chain that is trimming rather than hiring. Corporate guidance through the third quarter emphasizes higher materials costs, metals, electronics, and sub-assemblies as a central margin headwind, consistent with the tariff pass-through captured in purchasing data. Just to recap the mechanism in one line, tariffs that lift core inputs compress the very sectors they are designed to favor unless offset by subsidies or demand guarantees. Fiscal arithmetic is squeezing at the same time. Net interest outlays are up more than 12% year over year to roughly $580 billion for the first half of the fiscal year, a figure Reuters highlights as debt service costs overtaking many discretionary programs. The IMF and the Committee for a Responsible Federal Budget each warn that, under current policies, U.S. deficits remain structurally wide, keeping debt on an upward path even with tariff receipts. The Fed's modest cut and balance sheet pause cushion labor softness, but leave inflation risk alive. Monetary support is arriving incrementally while fiscal space tightens and import prices stay high. Global context complicates the calculus. The IMF upgrades world growth to 3.2%, but warns that trade tensions and tariff shocks raise dispersion and invite retaliation that reroutes supply chains rather than expanding them. In that setting, the dollar's path becomes a policy instrument by consequence. If the Fed eases into slowing manufacturing and rising long-term unemployment shares while tariffs persist, analysts at major banks expect the dollar to weaken over the coming year. A softer dollar can lift export competitiveness, but raises the local currency cost of commodity imports, pressuring real wages unless productivity or wage growth closes the gap. A trade-off already visible in consumer price composition when energy and goods components re-accelerate after tariff rounds. The legal endgame is unresolved but bounded. Reuters' legal analysis frames the Supreme Court's review as pivotal for emergency powers duties, while stressing that metals tariffs under Section 232 and potential recourse to Section 338 could preserve large parts of the program regardless of the ruling. The Council on Foreign Relations and the Congressional Research Service note Section 338's ceiling of 50% ad valorem and its rarely tested nature, which implies immediate effect but invites litigation and possible retaliation. If the White House pivots among authorities to sustain broad coverage, companies will likely continue planning for elevated import costs and ongoing licensing risk in technology supply chains, perpetuating the manufacturing and jobs dynamics already visible in PMIs and labor data. The result, policy continuity raises the probability that the current industrial slowdown endures into the next planning cycle. Corporate behavior underscores the shift. Nvidia's withdrawal from China as a forecasted revenue contributor signals the scale of market loss when export controls tighten and destination governments counter. On the buyer side, Chinese technology firms accelerate design and procurement of domestic accelerators, while Huawei's AI chips appear in new servers. For U.S. capital goods manufacturers, this means less exposure to Chinese demand in high-growth categories and more reliance on subsidized domestic projects, whose timelines are long and sensitive to interest rates, a dependence that ties factory floor conditions to the cadence of the Fed's easing, rather than to a spontaneous export recovery. Investment leans toward policy-backed nodes while market-driven export engines idle. Household budgets are the fulcrum. Purchasing manager anecdotes describe higher prices for basic inputs feeding into appliances, autos, furniture, and electronics, with the tariff layer cited explicitly. Incomes are still growing, but more slowly than last year, with average hourly earnings up around 3.7% year over year, barely above inflation. When more workers remain stuck in job searches for 6 months or longer, the propensity to cut discretionary spending rises, feeding back into retail and services headcount. One reason Challenger's data show layoffs mounting in consumer-facing categories. The short-chain tariffs lift prices. Prices squeeze real wages. Squeezed wages cut discretionary demand. Weaker demand triggers cuts. Financial conditions offer a narrow window. Bond yields have fallen on expectations that the Fed will need to reduce rates again to stabilize employment, with the 2-year Treasury at its lowest level since 2022. If easing continues into next year, the dollar could drift lower still. A softer currency might help exporters on price, but would also raise imported goods costs, complicating any attempt to cap inflation while tariffs persist. A balancing act reflected in the Fed's cautious language. With customs receipts elevated and deficits still historically large, the fiscal channel cannot absorb much more without broader reforms, the IMF warns. Policy choices are narrowing as the data converge. Layoff announcements at levels last seen during the pandemic, longer jobless spells, a manufacturing sector stuck in contraction, and a technology decoupling that removes a top-line growth engine all arrive in the same quarter. The White House can keep switching legal authorities to preserve tariffs or dial them down as court challenges progress. The Federal Reserve can counter with additional easing. Both tracks carry consequences that run through the dollar, prices, and payrolls. One high-frequency indicator will register the outcome before the election cycle finishes. The proportion of long-term unemployed in the labor market data, a share that tends to rise quietly and then all at once when the floor gives way. If that line climbs while customs receipts stay high and the dollar weakens on successive rate cuts, the story of the year will be written not in court opinions or podium remarks, but in a single number that refuses to turn. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.